In two previous episodes, we have illustrated the potential of Roth accounts. Today is part 3 in that series, and we will discuss some less common ways that these Roth accounts can benefit you over the long term. That's all coming up right now. Hello, welcome back to Wealth Wednesday. This is our YouTube channel at Commonwealth Financial. You can also find us on the web, which is where we have all the charts and stuff that you'll see in these videos. And that website is cfswv.com. And if you like this content, please hit that like and subscribe button. I'd like to welcome back Julie Daly, a financial advisor in St. Clairsville, Ohio, and Evan Brockmeyer, a financial advisor here in Marietta. Parts 1 and 2, we covered some of the more common things that you will see with Roth IRAs and Roth 401ks and using those to help you plan and save for retirement. And you can catch those episodes on our website as well as here on our YouTube channel. Today, part 3, and we're going to explore a couple of different ideas. The first is electing to classify your employer contributions as Roth-type contributions. Julie, can you explain how this works?
Sure, Neil. Thank you. So this is a new rule. So it's something new. It's part of what they call the Secure Act 2.0. And this was passed last year, however, became effective this year, January 1st, 2023. So how this works is you as an employee can elect certain employer contributions to be treated as Roth contributions. In the past, it had always had been that the employer contributions had to go to the pre-tax bucket in your 401k retirement plan. So here's how this works. The employer contributions you can treat as Roth have to be immediately vested, meaning that the money contributed by the employer is the employee's right away. So immediately you as the employee are vested with that contribution. So this is going to be certain matching contributions only and what are known as non-elective contributions. The employer is still going to get the tax deduction for those contributions, but you as the employee will have to report that amount as income. We're not quite sure exactly how that's going to show up on your tax forms just yet because this is the first year it's in effect. So as that money compounds, though, it is treated like all other Roth contributions. You won't pay taxes on the growth, and your children or beneficiaries won't pay taxes on any of the growth in the future either.
Now, Julie, the last couple of weeks, we've talked about an imaginary couple, the Jetsons. And in parts 1 and 2, we really looked at how they treated their own contributions. And again, you can see more of that on our website. But let's look at the potential impact if they added treating the employer side of this as Roth as well.
Sure. So you'll see a chart here brought up on the screen that is projected Roth balances only. So the yellow bars are if the Jetsons had left their employer contributions completely pre-tax dollars. And then the blue bars are as if they not transferred that, but chose to put those contributions into Roth money. So in the chart, we're going to isolate the Roth funds from their existing pre-tax contributions. So this is not their total account balance, it's just their Roth balances. Switching their employer contributions to Roth means that George and Jane will have $100,000 more in Roth-type accounts at retirement and $120,000 more at the end of Jane's life. So, but you have to keep in mind that they will still have some pre-tax dollars and their total in both sources will remain the same at retirement. We don't have that shown here in this chart. But it also means that they'll have more at the end of their lives. And if they switch their employer contributions to the Roth.
So this is going to impact their current tax situation as well. How does that project over the next several years?
Sure. We have one more chart pulled up here. So we are projecting that switching their employer contributions to Roth will raise their tax bill by $15,166. We saw in episode 1 that switching their contributions to Roth would cost them more than $53,000 during their working years. So $68,000 more in tax consequences during their working years. We also projected an additional 58,000 of potential additional tax savings to their kids. So these numbers aren't huge by themselves, but it does have an overall impact on their finances.
Evan, the next idea that we use is maybe a little harder to graph out is what if the Jetsons were to want to retire at 60 and have to buy their own health insurance? How could having Roth dollars impact that?
Yeah, so one of the major thoughts for those that are retiring before you hit age 65, Medicare eligibility, is the cost of health insurance out of pocket. And that number can reach $1,000 per month per person pretty easily. So you do some quick math, that's not a small number. And if you only have pre-tax dollars to cover those expenses, then it can actually make your cost even higher because of having to gross up those distributions to cover the taxes. So, for example, if you needed $5,000 at a given time and you're paying 15% at the federal level, 5% at state, then you're adding another $1,000 just to get that $5,000 out. So it's costing you more upfront. And then having those Roth accounts can do a few things. And the biggest is related to your adjusted gross income. So the Roth accounts, when money's withdrawn, it doesn't add to your AGI, whereas the traditional pre-tax accounts, that would count against your gross income. So that's huge, because if you qualify for the health insurance premium subsidies through the Affordable Care Act, taking the Roth money can actually reduce and potentially eliminate your premium expense in that case, because it's lower than if you had to take pre-tax dollars. So that coverage from the Affordable Care Act healthcare marketplace may not be the greatest, but it's still an option to help you avoid that overall premium before you hit Medicare. So all things considered, if the Jetsons in this case plan to retire before 65, then that Roth money can have a somewhat hidden impact on their situation.
Exactly. And Julie, there's some other hidden gems here as well.
Sure. So with Roth accounts, this will help you avoid possible IRMAA taxes. So these are additional amounts that you have to pay for Medicare based on your income. So Roth contributions don't count towards that. Another gem is Roth accounts can lower or eliminate the taxes you pay on Social Security benefits in the future. So if you have your income coming from Social Security and pre-tax 401ks or IRAs, you may find that 85% of your Social Security benefit is taxable. Distributions from Roth accounts don't currently count as income, and you may be able to reduce those taxes as well. So it may keep your taxes due on capital gains at zero also. Right now, if your income is under a certain limit, you don't owe any capital gains taxes throughout the years.
Yeah, and those types of things are very intriguing and very interesting. You know, the limits at which your Social Security benefits become partially taxable is probably one of the biggest impacts. Now, Evan, we've shown over the past couple of weeks, one is a couple in their 60s who convert their pre-tax to Roths, and this couple, the Jetsons that we've talked about, is in their 40s and just change their contributions to Roth going forward. Mm-hmm. Speak for a moment in how time is such a big factor in all of these illustrations.
Yeah, it all comes down to the compounding effect of the growth on these investments. So you're essentially paying the taxes today in the Roth case to not pay taxes on the earnings and the growth in the years ahead. And the expectation is that over the course of time with market history, earnings and growth are going to be significant. And that's especially the case for those who are in their 20s and 30s. And when we illustrate this for those types of clients, we even intentionally dial that back a little bit, because the compounding effect can yield some pretty incredible values. And, we definitely don't want to be overly optimistic, but there's benefits for folks at any age to take advantage of this. And it proves why it's important to have an eye on the tax and the planning side of this, because it's not purely just investments and investment returns. It's capitalizing on tax code and the laws that are out there. So all of this ultimately ties together.
Yeah, and I still can't believe our government has created this for us. It's an amazing tool and it's incredible. And I hope that these episodes have shown and illustrated how impactful it can be on your life. And if you would like more information, you can reach out to someone like Julie or Evan or myself at our website. That's cfswb.com. Thanks for watching. Have a great week.